Hello sir, all my friends. We are from Group 1 and today we are going to discuss about the overview of financial statement analysis. But first of all, I would like to introduce my group member. There are Ardi Kurniawan, Anggino Faisa Asmir, and last but not least, it's me, Clara Molina Sibarani. Okay, so we're going to talk about the business analysis. The first thing is about the introduction to business analysis. So financial statement analysis is the part of business analysis. So business analysis is the evaluation of a company prospect and risk for the purpose of making business decision. This business decision extends to equity and debt valuation, credit risk assessment, earning prediction, audit testing, compensation negotiation, and countless other decisions. So business analysis aids in making informed decisions by helping structure the decision task through an evaluation of a company business environment, its strategies, and its financial position and performance. So an initial step in business analysis is to evaluate a company business environment and strategies. The next is about the types of business analysis. So business analysis is applied in many forms and is an important part of the decision of security analysis, investment advisor, fund managers, investment bankers, credit raters, corporate bankers, and individual investors. So we're gonna discuss the first is credit analysis. So credit analysis focuses on downside risk instead of upside potential. So this includes analysis of both liquidity and solvency. Liquidity is a company's ability to raise cash in short term to meet its obligation. Liquidity depends on the company cash flow and the makeup of its current asset and current liabilities. The tools of credit analysis and their criteria of evaluation vary with the term or maturity, type, and purpose of the debt contract. So with the short-term credit, creditors are concerned with current financial condition, cash flow, and liquidity of current asset. With the long-term credit, including bond valuation, creditors require more detailed and forward-looking analysis. Long-term credit analysis include projection of cash flow and evaluation of extended profitability and also called sustainable earning power. The second is about the equity analysis. So equity investors provide funds to a company in a return for the risk and rewards of ownership. Equity investors are major providers of company financing. Equity financing, also called equity or share capital, offers a question of safeguard for all other forms of financing that are senior to it. This means equity investors are entitled to the distribution of a company asset only after the claims of all other senior claimants are met, including interest and preferred dividends. As a result, equity investors are said to hold a residual interest. This implies equity investors are the first to absorb loss when the company liquidates, although their losses are usually limited to the amount invested. The third is about the other uses of business analysis. So business analysis and financial statement analysis are important in a number of other contexts. So the first is the manager. So analysis of financial statement can provide manager with clues through strategic change in operating, investing, and financing activities. So managers also analyze the businesses and financial statement of competing companies to evaluate a competitor's profitability and risk. The second is merger, acquisition, and divestitures. So business analysis is performed whenever a company restructures its operation through merger, acquisition, divestitures, and spin-off. The third is financial management. So manager must evaluate the impact of financial decision and dividend policy on company value. The fourth is directors. So as elected representative of the shareholders, directors are responsible for protecting the shareholders' interests by vigilantly overseeing the company activities. Fifth, there are the regulators. So the Internal Revenue Service applies tool of financial statement analysis to audit tax return and check reasonableness of reported amounts. The next is labor unions. So techniques of financial statement analysis are useful to labor unions in collective bargaining negotiation. And the last is there are customer analysis techniques are used to determine the profitability, or we can call it staying power of supplier, along with the estimating the supplier profits from their mutual transaction. Okay, so that's all from me, and the next discussion will be handled by Anggi. So Anggi, time is yours.
Hello everyone, Assalamualaikum warahmatullahi wabarakatuh. I am Angino Faisha Azmir, so I will continue the presentations of this group. Okay, for the next material is about components of business analysis. The first is accounting analysis. So accounting analysis is a process of evaluating the extent to which a company's accounting reflects economic reality. So this is accomplished by looking at a company's transaction, events, assessing the effects of its accounting policies on financial statements, and also adjusting the statements to both better reflect the underlying economics and make them more amenable to analysis. And it is also often the least understood, appreciated, and effectively applied process in business analysis. And the things we must remember is this is so crucial to any successful business or financial analysis. And the second, financial analysis. So financial analysis is the use of financial statements to analyze a company's financial position and performance, and to assess future financial performance. And it is consists of three broad areas. There are profitability analysis, risk analysis, and analysis of source data and use of funds. Okay, so we move to basis of analysis. The first is business activities. So business activities is when a company pursues a number of activities in a desire to provide a sellable product or service and to yield a satisfactory return on investment. So in financial statement and related disclosures inform us about the four major activities of the company. The first is planning, the second is financing, investing, and also the last is operating. So the business activities is to understand each of these major business activities before we effectively analyze a company's financial statement. Alright, so the second of basis of analysis is planning activities. So planning activities is a company's goals and objectives are captured in a business plan that describes the company's purpose, strategy, and tactic for its activities. There are two important sources of information on company business plan are the letter to shareholders and also management's discussion and analysis. So a business plan assists managers in focusing their efforts and identifying expected opportunities and obstacles. So insight into the business plan considerably aids our analysis of a company's current and future prospects and is part of the analysis of business environment and strategy. Okay, so the third of basis of analysis is financing activities. Financing activities is a company requires financing to carry out its business plan. So there are two main sources of external financing. The first is owners or shareholders, and the second is creditors or lenders. So return is the equity investors' share of company earnings in the form of either earnings distribution or earnings reinvestment. Earning distribution is the payment of dividends to shareholders. And the second is companies also obtain financing from creditors. Creditors are two types. The first is debt creditors and the second is operating creditors. Okay, so I think that's all for me. For the next material will be explained by my friends Ardi Kurniawan. For Ardi, time is yours. Thank you.
So here we're gonna talk about investing activities. Investing activities is a company acquisition and maintain of investment for purposes of selling product, providing service, and for excess cash. Investing activities decision involves several factors such as type of investment necessary, including technological and labor intensity, amount required, acquisition timing, asset location, and contractual agreement. Decision on investing activities determine a company organizational structure, like centralization or decentralization. It will be effect on growth and influence of risk of operation in a company. Next is about operating activities. Operating activities represent the carrying out of the business plan. Even it is financing and investing activities. In operating activities, they have 5 possible components, like research and development, procurement, production, marketing, and administration. For your information, operating activities here is a company primary source of earning. Earning here is reflect to a company's success in buying from input market and selling out in input market and output market. Next is financial statement reflect business activities. Usually at the end of the period, is like quarter or for 1 year, financial statement prepared to report on financing and investing activities at that point in the time, and to summarize operating activities for the preceding period. The first one we have balance sheet. The accounting equation, also called the balance sheet identity, is the basis of accounting system. Asset liabilities, and equity. These resources are investments that are expected to generate future earnings in operating activities. And the second one we have income statement. An income statement measures a company's financial performance over a period of the time, typically a year or a quarter. It is financial representation of the operating activities of a company during the period. Third, we have statement of change in shareholders' equity. This statement is useful in identifying reason for change in equity holders' claim on the asset of a company. And the last we have statement of cash flow. Statement of cash flow report cash flow and outflow currently for a company operation, investing, financing activities over a period of the time. And next we have financial statement analysis preview. This is a new topic. So for the tool we can use for analysis is, we have 5 tools for analysis. The first one is comparative financial statement analysis. So comparative financial statement analysis is individual conduct comparative financial statement by reviewing consecutive balance sheet, income statement, or statement of cash flow from period to period. The second one we have common sense financial statement analysis. Common sense financial statement analysis is useful in understanding the internal makeup of financial statements. The third one we have ratio analysis. Ratio analysis is among the most popular and widely used tools of financial analysis. A ratio expresses a mathematical relation between two quantities. The next is cash flow analysis. Cash flow analysis provides insight into how a company obtaining its financing and deploying its resources. It also used in cash flow and forecasting as part of liquidity analysis. And the next is valuation model. Valuation model is an important outcome of many types of business and financial statement analysis. Valuation normally refers to estimating the intrinsic value of a company or its stock. The basis of valuation is represent value theory. They have 2 model of valuation model. The first one is debt valuation, and the second one is equity valuation. Okay, I think that's all from us. Thank you for watching, and assalamualaikum warahmatullahi wabarakatuh.